I'm more bullish on Ethereum than anything else. And I think the new strategy of actually making kind of like a beefed up L1 is actually quite interesting, because that helps to scale more on the mainnet while still having these more specialized L2s.
Hey everyone, continuing our coverage of Ethereum's 10th anniversary, today's guest is Stani Kulechov, founder of Aave, one of the OG lending protocols in DeFi. Stani reflected on Ethereum's evolution over the past decade to what he sees coming next for DeFi. I found it remarkable just how bullish Stani is on Ethereum, despite all the criticism of the last year and change. He has full conviction in Ethereum as still being the best place to build, and that's why he's especially excited for Ethereum to scale the L1 while leaving room for specialized L2s. In fact, he pointed out that when looking at growth charts, the biggest network where Aave has grown the most is Ethereum mainnet. So Aave's core business is there, and they're doubling down on that and making sure that they're successful on Ethereum L1 and that they onboard real-world assets there as collateral for institutions. And for Aave, Solana's ecosystem so far hasn't brought in the kind of players that Aave would like to work with. What also stood out to me was his vision for how TradFi, fintechs, banks, and other centralized entities will have front ends and have distribution, but be powered by DeFi in the background. It's a compelling vision. Software that's more trustworthy, secure, and reliable than the current opaque system. At one point he said, "Onchain does it better," which I feel like will be conventional wisdom in the future. He also gave me a bit of a preview for Aave V4, which he describes as a major step toward making DeFi infrastructure more seamless, especially for institutions. To that end, Horizon, Aave's new platform aimed at bridging traditional finance and DeFi, has already been bringing real-world assets on-chain, so those users can borrow stablecoins. As he said, quote, "Tokenization doesn't really add value until you have some sort of use case." As for his take on all these new treasury companies, he said some of the Ethereum ones are actually using Aave to get free leverage for their positions, since what they're earning on borrowing is more than their cost. If you're wondering where DeFi is going over the next 10 years, I think you'll find his perspective really insightful. As always, let me know in the comments what you think. We might feature your remarks on the show. Heads up, everyone, we've got exciting news. Bits and Bips, our Macro Meets Crypto show, is officially spinning off into its own podcast feed, YouTube channel, and X account. If you've been enjoying the deep dives into interest rates, monetary policy, and how they intersect with the crypto markets, make sure to follow Bits and Bips wherever you get your podcasts, on YouTube and on X. You'll find the links to YouTube, X, and other podcast platforms in the show notes. If you're watching this, there's a QR code on screen. We'll be posting here for a few more weeks, but starting in September, Bits and Bips will launch on its own feed. For now, we will publish longer clips from the show on those accounts. Remember, go to the show notes now and subscribe to Bits and Bips, that's Bits, +Bips, spelled BIPS, on YouTube, X, and wherever you get your podcasts. One early Bitcoiner sold 30,000 BTC too soon, missing out on over $1 billion. Don't want to make the same mistake? With Xapo Bank, eligible members can get instant cash without selling their Bitcoin. Check out xapobank.com/unchained for more. Imagine an AI that speaks crypto and does the work of a team of analysts. Trusted by 80+ institutions, now open to serious traders like you. Visit askfocal.com. Hey everyone, welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. I'm here with Stani Kulechov, founder of Aave. Welcome, Stani.
Thanks for having me here, Laura. Pleasure to be at Ethereum's 10th birthday.
I know, it's so exciting. So, on this 10th anniversary, first of all, I want to give you a congratulations. And I know you don't work directly on Ethereum, but you're a major part of the Ethereum community. Aave especially is. And, Ethereum really has had a tremendous achievement. It's had zero downtime. There's been all of these technical upgrades. It has a $450 billion market cap. And Aave, it's far and away the largest lending protocol. It's got 30 billion total value locked. So I'd love for today to just be a little bit more of a free-flowing conversation. And I was just interested, what are your main thoughts when you think about this huge milestone that Ethereum has reached?
10 years is quite a long time, and I mean, it's a full decade, and we started building on Ethereum in I mean, I started to explore as early as 2016, and DeFi wasn't really kind of like a point yet at that point. And there was ideas about decentralized exchanges. Ether Delta back in 2016 was a really interesting idea, and that basically took a little bit more. Well, it started after the DAO hack, but it didn't get any traction because the experience wasn't really as smooth as swapping assets today in decentralized exchanges. And later in 2016 took a little bit more traction, but that is the time when I stumbled upon on Ethereum and thought it was a really interesting idea of actually bringing lending and borrowing and bringing the interest rate markets onto Ethereum, because in some ways the way I saw EVM smart contracts is a kind of a perfect an environment for building financial applications. And in 2017, we actually started to build ETHLend, short for Ethereum lending, which was a first kind of like a protocol and a DApp decentralized application of lending and borrowing. So for me, seeing kind of like at that moment of starting something small as a more of like a hobby side project while still being studying in university and being so young, and now kind of seeing that's almost like now it's been like 8 years building on top of Ethereum. It really feels amazing because DeFi has grown, stablecoins have become a substantial part of Ethereum, and also something that is really getting mainstream adoption and legislation as well, and also RWAs and tokenization. So for me, this is kind of really a moment to look back and realize like how small the community and ecosystem was in the first place, and everything was purely like an experimentation. And as of today, we have protocols like Aave that is actually having 56 or something billion net deposits and 30 billion in TVL. It just feels like a kind of like a surreal, to be honest. But it's what our aim was, like decentralizing finance, and here we are. And between now and then, there hasn't been any kind of an issue on the underlying network. So it proves and resiliency is and what it as a kind of a blockchain and a network can achieve. So very happy about the moment.
Yeah, it's funny. I got into this little back and forth on Twitter earlier today with Dan Held, who I respect. I mean, he's very successful and super smart, and I like him as a person. And he is a Bitcoiner. And I had tweeted something about how Ethereum had zero downtime during those 10 years. And he, kind of was disputing that and saying like, oh, but there was the DAO and, the hard fork and all this stuff. And I was like, yeah, okay, but there was no downtime in any of that.
Yeah.
And, just when you think of like all the travails that Ethereum has been through, because that year in particular was like the DAO, and then it was the DDoS attacks in Shanghai. And, and that was the time when like the multi-client, strategy really paid off for them, because, there were moments when some of the attacks kind of like, were more targeted to one client versus the other. And so they could kind of like trade off between those. But anyway, I just wanted to also ask you, you were talking about like when you first started getting into Ethereum and how you started with ETHLend and everything. And I mean, it's just so crazy that, now here you are, you've grown so much. So, I'm curious, like when you started, what was your conception of what you were building, and how did that change along the way? Like, how did you become the number one lending protocol on Ethereum?
At least when we started, there wasn't really liquidity on chain. So a lot of these assets that were on Ethereum in the first place, it was a group of assets, and mainly consisting of governance tokens or some really ambiguous tokenomics. And that was like 2017. So you name it, like everything we saw like projects that were trying to do something really exciting, serious, to something not so serious, like putting cats on the blockchain and whatnot. And
Or Dentacoin.
yeah, there was basically an ICO for every single flavor. But what I realized back in 2017 is that what we wanted to achieve, like the vision, couldn't really be achieved at that point. So what we were building is more of kind of like a peer-to-peer system that is using smart contracts, securing the user's collateral into an escrow, and then you can lend against these collaterals and earn interest, and that's great and amazing. But a lot of these collateral assets were not that liquid in the first place, and this was a time when stablecoins didn't really exist on Ethereum. So if you look at the bigger stablecoins like USD T and USDC didn't exist in that time yet. That was in a Omni network and traded mostly on centralized exchanges. So we tried to come up with different kinds of like hacks and solutions where a user basically locks up a collateral and borrows, let's say, USD pegged Ethereum. So borrows 1,000 USD worth of Ethereum and returns later the same amount of USD worth of Ethereum with some interest. So we had to kind of like have hacks back then, and something kind of like what happened between that, like 2017, 18, and later 19, is that we saw more liquidity coming on chain. It was still really not as concrete as it is, for example, today, but that changed completely the dynamics on how to build decentralized financial applications. So, for example, instead of building these kind of like isolated risk models like we did with ETHLend, we came up with a new model with Aave that followed this pooled model. For example, what Uniswap had, well, basically pool liquidity together, and that kind of like a model is something which is pretty much all DeFi is based on, because when you pool liquidity, you have better network effects, liquidity network effects in that perspective. So a lot of the things we wanted to build, you couldn't really achieve yet then. And also another thing I want to say from like developers' perspective is that the tooling was very kind of, there was very little tooling. So if you are building DeFi today, you're kind of blessed on Ethereum because you have really good development environment. You have ability to do very seamless testing. You have a lot of tooling around simulations, and a lot of this tooling didn't exist back in 2017, 18, and onward. So I think that's how kind of like things change, at least on our side.
And so throughout this time, I'm curious to hear also like what it's been like just as a builder in the ecosystem, even including things like the foundation. Like I actually just finished a conversation with Tomasz Stanczyk, one of the new co-executive directors of the Ethereum Foundation. And I wondered, for you as a builder, just what you feel like the evolution of Ethereum and the EF has been during that time. Because as I'm sure you're aware, last year there was a lot of, what's the word? A little bit of criticism
Social
and
pressure.
yeah, a bit of revolt. People, were even calling for, the leadership of the EF to change. And some people were saying, I'm leaving Ethereum. Eric Connor is probably one of the more well-known. And I was just curious, like, during this whole time that you've been building, like, what has it been like for you?
Yeah, I mean, we don't typically think much about Ethereum Foundation when we build. Like, we understand their role in the ecosystem as a kind of like a guiding and signaling. So, Aave will be successful regardless of Ethereum Foundation. But what Ethereum Foundation can do is make certain choices that can accelerate the ecosystem, accelerate DeFi, and it's a fundamentally a big node in the network. And I think that's something I've been very critical of EF for the past years, is that the very little involvement in DeFi, both from like the treasury management perspective, but also highlighting decentralized finance as a kind of like flagship use case for blockchain. And I think it really makes sense because blockchain in the first place was coined from a financial use case, peer-to-peer transactions, what, for example, Bitcoin was all about, and Ethereum credit is kind of like a of decentralized computer, and obviously you can do financial transactions and also like non-financial use cases. And for me, kind of like seeing DeFi getting into a place where there is a lot of resiliency. I mean, the biggest moment for me personally was seeing the FTX hack happen, and at that point we had a lot of inflows of users that actually wanted to use decentralized alternatives and non-custodial wallets instead of keeping their funds at an exchange. And at that same point, because FTX wasn't like the main thing, there was FTX, but then there was also Celsius, there's lending. There's so much contention happening, and just like kind of like a chaos everywhere. For me, like the resiliency, which is kind of like a foundations for Ethereum as a network and Aave as the lending that was happening off chain by these centralized crypto businesses, basically completely disappeared. And a lot of that business came on chain, effectively towards the point that as of today, Uniswap being able to achieve really significant trading volumes compared to centralized exchanges. So my kind of criticism was like, if DeFi has been able to get this far and we prove this resiliency, why EF couldn't actually double down on DeFi and make this opportunity kind of more clear to everyone. And that can be a ways of utilizing the treasury in DeFi, helping to get more talent into DeFi space, kind of like a moment for EF to really make this change and then actually realize how they can participate more in the ecosystem. So I'm quite happy about the outcome, at least what it relates to DeFi and also accelerating the Ethereum roadmap.
Yeah, I love what you said about how on-chain does it better, because I do feel like that was such a big learning from that year 2022. But what's interesting, I'm sure you saw the news about how JP Morgan is going to offer Bitcoin and Ether lending. I don't know if you had any thoughts about that. Does that give you pause or make you worry? Or I don't know what your thoughts are on that.
Well, typically when institutions are thinking about borrowing lending, they try to figure out how to do this infrastructure on their own. But actually in reality, where you're using a system like Aave is actually quite interesting for fintech banks and asset managers who want to do this type of crypto-backed loans. Because if you think about like what kind of infrastructure you need to run if you do this as a business, so the amount of people you need to actually manage the risks, manage the collaterals, manage the operations of that business model, and then you have to develop that technology. I think you actually get, and you need to run it in a resilient way. So I think you are better off of using something like Aave as an infrastructure for that type of a business. And the reason for that is that when you are using smart contracts, you really can offload a lot of the operations to and automatize a lot of the business logics into the protocol. And this is the kind of benefit of DeFi, is where if you use something like Uniswap or Aave, you're able to limit a lot of risks that might be related to execution risk, whether it's the underlying network like Ethereum or the protocol itself. So and you can actually ensure that economically you have a secure and resilient model. So we quantified that Aave has so far liquidated over 3.2 billion worth of collateral, and the biggest amount, for example, has been 300 million a week, and we had even 200 million liquidation earlier this year, which was liquidated in a few minutes. So it just showcases that like what you can actually do and offer to your customers as a distributor, like a bank, while using this technology in the backend. It's so-called DeFi mullet, where you have a centralized business, you have distribution, but then in the background you are using decentralized finance. So this is kind of like my hope of the direction all the fintechs and also banks are going to when they're thinking about using the collateral. Of course, the reality is that it will take time when banks take another step towards decentralized finance. But I think that's the ultimate goal.
Oh, that is so interesting. So basically, and I understand this obviously isn't where these banks are going to start, but you would say like ideally there would be some sort of like white label solution or something, or it doesn't even have to be. It's just like there are multiple front ends to Aave or whatever other DeFi lending protocol. And it could be the bank that you've always used, or maybe you go to a website, like maybe you decide that you just want to kind of do it on your own. But there's like a whole kind of spectrum of ways to access the same backend technology. Is that what you're envisioning? Okay.
Yeah, typically when we have developers or anyone that wants to integrate Aave, they integrate directly the existing pools. So we recently announced an integration from MetaMask, and they simply allow users to use Aave directly from MetaMask. So they see their balances, they see USDC, and they can supply and earn. And those funds go directly to the main pools. But there's another cases like, for example, with Kraken and Inc., where actually they wanted their own infrastructure. So they wanted their own market deployed on their own network. And in that case, they're simply using Aave as a infrastructure there. So in some ways, you have two options. You can access the direct liquidity that is already in DeFi. And the other option is that you basically have more control and use this white labeling mechanism. And I think that's an interesting way for DeFi to actually offer solutions as well for these traditional institutions that are entering into the space, but they might want some sort of own customization, own type of assets or risk parameters, or even interest rate models. So I think that's the kind of like a way where DeFi and traditional finance or fintechs will kind of like converge.
All right. So in a moment, we're going to talk a little bit more about what's on tap for Aave coming forward. But first, a quick word from the sponsors to make this show possible. Selling your Bitcoin just to get cash? One early Bitcoiner did and missed out on over $1 billion. With Xapo Bank, you can access up to $1 million instantly without selling a single sat. Eligible Xapo Bank members can borrow up to 40% of their Bitcoin's value. No stress, no selling, no buying back in. Use it for what matters most. Your dream home, your child's education, a getaway, or that can't miss investment. With Bitcoin-backed loans, you're in control. Set your installments and repay in Bitcoin or US dollars, your choice. Enjoy competitive rates, zero fees, flexible terms, and no penalties for early repayment. And your Bitcoin stays safe, never rehypothecated, relent, or pooled. It's securely held until your loan is repaid. Check them out at zapobank.com/unchained. Heads up, everyone, we've got exciting news. Bits and Bips, our macro meets crypto show, is officially spinning off into its own podcast feed, YouTube channel, and X account. If you've been enjoying the deep dives into interest rates, monetary policy, and how they intersect with the crypto markets, make sure to follow Bits and Bips wherever you get your podcasts, on YouTube, and on X. You'll find the links to YouTube, X, and other podcast platforms in the show notes. If you're watching this, there's a QR code on screen. We'll be posting here for a few more weeks, but starting in September, Bits and Bips will launch on its own feed. For now, we will publish longer clips from the show on those accounts. Remember, go to the show notes now and subscribe to Bits and Bips, that's Bits, +Bips, spelled BIPS, on YouTube, X, and wherever you get your podcasts. Looking for your next big trade? Want to track every move in your portfolio, news, unlocks, price action, and open interest in one place? Meet Focal, your personalized AI assistant for crypto. Built for institutions, now open to serious traders like you. Focal surfaces high signal insights, automates your workflows, and helps you move faster in 24/7 markets. Find out why the smartest desks use Focal to stay ahead. Sign up at askfocal.com. Back to my conversation with Stani. So, we referenced this briefly before about how last year was a bit of a challenging time for Ethereum. We saw the ETH price didn't gain anywhere near as much as Bitcoin or Sol. Obviously, kind of the center of the mania last year was on Solana. During the time when people were kind of making a lot of noise about wanting change in Ethereum, I had Mark Zeller, head of the Aave Chan initiative, on the show. I asked him about deploying on Solana, and he basically just, I should have looked up the exact quote, but he said something dismissive about how he didn't see the metrics that he needed to say that he would want to do that. And, I was just curious to know, how you think about that particular sort of choice that is out there, because Ethereum definitely has gone more in this direction of modular, I would say, so they went very far in the direction of modular. Now they're saying they're going to scale the L1, so there's a little bit more of I guess you could say a little bit of a course correction. I mean, it's not that they're giving up on the strategy, but that they're sort of recognizing that they probably could have scaled the L1 as well. But then here we have Solana with a different path. Potentially, maybe someday they will do their network extensions, which is more similar to the Ethereum model. But, as a builder, I was curious, when you're looking at sort of the different options in the market, how do you think about them?
Yeah, I mean, Ethereum had a kind of a weird situation where everyone wanted a lot of block space, and a lot of block space then means that you have a lot of growth, essentially. So you can have all kinds of applications, and you don't have the congestion and high L1 fees that you typically would have. And obviously that affects the economics. So when you have a lot of block space, it means that users are paying less because they are, they're benefiting for L2s. It's kind of the same thing as, when cellular phones came and you had text messages and they were quite pricey. And I mean, sending one message was quite a lot, and later at some point the pricing went down and you had packages, and now it's pretty much kind of like a package and almost free to send these messages. And same with internet bandwidth. So I think kind of the really challenging part is that when the Ethereum scaling went towards the L2s and you got all this block space, obviously that affected the economics. Now it means that you will charge less of the usage from transactions. They can do a lot of different things, but that means also less revenue comes into the network. So then that kind of created, well, not specifically that, but the lack of revenue, for example, created also this narrative of whether Ethereum should actually charge more and tax more of these L2s, and propose all kinds of things that actually I would say if you think about Ethereum as a startup, you have to just focus on growth, invest in growth, and you don't think really about monetization or revenue until you have a significant market share, or you kind of it's the classical a Uber example. Invest aggressively into growth, and you want to grab the deepest market share, and then because you have almost a monopoly, you can actually then charge everything back. So that was a kind of a challenging piece. So and now obviously last year a lot of discussion came, and Ethereum is now going towards this direction. Well, what if we start to scale the L1? When it comes to Solana, I think one of their benefits obviously has been the low cost of the because of the centralization, and you can do you are not decentralized, for example. So, and I think that's some ways was helpful for onboarding a lot of these meme coins, everything goes, and we sell pump.fun. It's interesting to think about how valuable that is, but I could argue that any type of attention is important and creates value. That's essentially what social networks are for. And from more of like so user perspective, I understand why there was a lot of growth there, and you can now have the same type of experience on L2s, but obviously you have to create that culture that existed, and Base is kind of like Ethereum's on the Ethereum side trying to capture that type of a market share. But from the builder's perspective, I think the challenging part, obviously, on building a Solana is that lending and borrowing specifically from another type of angle. And you don't have mempools, for example. You need to think about liquidations and how to ensure them when you have basically first in, first out type of rules. So then you're dealing with different type of a code base. The expertise is different, and the people, auditors, the tooling is different. It's not in par, for example, with Ethereum. So there's a lot of kind of like nuances that you have to think when you build. And the thing is that it's not really an impossible idea to go and build a version of Aave there. And it definitely can be successful because Aave has this kind of like a sense of culture, brand, and really brings this trust in the user base. And I think I do agree also on the fact that there has to be a lot of reasons to do that. But at the same time, if you look at all the growth charts, basically the biggest networks where Aave has grown is the Ethereum mainnet. So even if the transaction costs are cheaper on L2s, the most growth is still happening by far on the mainnet. So that's where the kind of like a core business exists at the moment. So yeah, that's my kind of like thinking. It's totally possible. It takes time. It requires expertise, but at the same time, we want to focus on making sure we're by far successful on mainnet. And there's a lot of actually work to be done on mainnet, especially as RWAs are coming and using them as a collateral, working with institutions. So I would say like there's a lot of prioritization.
And one question, just because, in my opinion, the whole sort of, smart contract blockchain space is like, it's, Ethereum, it clearly is the leader right now, but it's also so early in crypto. And, Solana sort of is this like up and comer, there's some potential it could, it's already competed directly in certain ways. Like, we saw in the Electric Capital report last year that they said that was the first year developers in Ethereum had decreased and Solana had, what was actually the one that had the highest percentage increase. But it seems like you feel comfortable kind of like putting your eggs in the Ethereum basket. Like you just seem to have faith that will be,
I also I would like, I think the developer report is a really good piece of research, but also I want to highlight that, when you have a new ecosystem, you will see a lot of copy paste projects, and it's always the kind of like the same thing, that all the same DeFi projects are replicated. And yes, there is like a lot of action and activity from developers writing code, but at the same time, what's really interesting is like what is the kind of like a innovation that really sticks, and that really isn't proven on Solana. I mean, pump.fun has been doing pretty well in terms of fees and in terms of the attention economy, but at the same time, 90-something% of the users are losing funds. So it's still kind of like unclear if that will be the main driver there. I do think DeFi is really kind of like the cornerstone of all blockchains, and that's somewhere where we probably see more growth on Solana. But at the same time, a lot of institutions are choosing Ethereum, a lot of developers are choosing Ethereum, and because it can bring that resiliency and guarantees. End of the day, I know it for some people it might not matter from like the security perspective, but end of the day, when you're dealing with really significant amount of funds, it does matter at that point when you put everyone on the same line and compare. So I'm more bullish on Ethereum than anything else, and I think the new strategy of actually making kind of like a beefed up L1 is actually quite interesting, because that helps to scale more on the mainnet while still having these more specialized L2s.
So one other thing that I just needed to ask you about, and I just have a few more Ethereum questions, and we're going to shift more to Aave in a bit. But here we are. We're in the midst of this big crypto treasury trend. It sort of feels like every single day there's a new Ethereum vehicle. So we have Bitmine, SharpLink, BitDigital, GameSquare, BTCS, Ether Machine, Etzilla. There's others that I'm sure I didn't catch, but I was just curious to hear what you thought of the trend, because as somebody who's running a DeFi lending protocol, you're very well aware of like liquidations, of kind of cascading effects, and there have been a lot of people who have been talking about how they feel like they're watching that in the making right now as they're watching this trend take off. And yeah, I was just curious if you worried about how that might impact Aave or its users or Ether or any of the above.
Two interesting observations. So I think the trend will continue to the extent that we will see that kind of like a premium between holding underlying ETH or any other assets, and then the actual premium of the shares kind of like evaporates. So I think we will see that. And a lot of these initiatives are truly just replicating, obviously, the micro strategy play. And something interesting about the micro strategy is that they do have a really like good marketing angle as well. So you have Michael Saylor, and that plays a key role. So I think the success of that kind of like premium depends on that side of the vehicles, like the actual marketing, the distributions, and so forth. But I do think that we do see like big Ethereum ETH movements at the moment, and some of these treasury vehicles are also using Aave for essentially leveraging a little bit of their position at a kind of like a net basis free for BTCS is putting roughly was it 180 million worth of or 200 million worth of ETH as a collateral, and they're borrowing roughly 50 million worth of stable coins to buy more ETH that they further collateralize. So what they're earning from their collateralization interest is offsetting their borrowing costs. So effectively, they're getting a free leverage on their holdings. And I think the cascading liquidations, individual basis of whether they use, let's say, Aave directly. Obviously, I personally don't want to see high leverage, but I do understand that seeing Aave is interesting. You have a transparency, and anyone can follow that position for shareholders, for example. But at the same time, and you have that, like kind of like a best execution there. But I don't want to see too over leveraged positions from that regard. And in terms of liquidations, I think that the biggest kind of moment was when we saw the news about the tariffs, when suddenly overnight Ethereum dropped for 30-25%. A lot of these liquidations, and one kind of like a single day, in actually in a few minutes, we liquidated over 200 million worth of collateral, and most of it is basically ETH. So it just showcases that actually, yes, if you have a lot of liquidations, they can affect systemic risk. But the best place to actually handle the systemic risk is a system like DeFi, where you have full visibility and You also can quantify the systemic risk across not just Aave, but let's say Sky and all these other protocols. And it's a decentralized liquidation mechanism where everyone can come and step in and to liquidate. And this kind of like reminds me back in the Black Thursday in 2020, when early days of Aave, actually, when Aave launched on version 1 in January 2020, and obviously COVID hit quite hard on March. And at that point, there was like this kind of a chaotic situation in DeFi, which was fraction of a small it is today. Everyone was trying to liquidate these positions, and a lot of protocols successfully. It just showcases like kind of like when you have an open system where anyone can participate, you can actually increase the resiliency versus in a closed system. So that's why I'm kind of like excited to build DeFi and try to get all these like centralized market participants, whether it's treasuries or whether it's fintechs looking to offer crypto-backed loans, or banks looking to do something similar, to actually just like use DeFi as the backbone, because that gives everyone the same visibility, access, and participation. And I think that creates a more resilient system.
So it's not only Ethereum that has reached a major milestone, but Aave has several to report on its own. So, you recently reached $170 million in cumulative revenue. You have about $23 billion in active loans on Aave, which is more than every competitor combined. If Aave were a bank, it would be the 42nd biggest bank in the US based on deposits. And you've reached $2.85 trillion in all-time supplied assets. So all of this is just massive. And yet, here we are. You're soon going to be launching your long-anticipated Aave V4. So tell us what we can expect in that new version, and why people should be excited about it.
Yeah, I think the new version is quite interesting because it's a really new type of, I would say, like a next generation of lending protocols. And the reason for that is we basically take everything we learned with the previous versions of Aave and improve certain features or added certain features that really doubles down, for example, on capital efficiency, doubles also down on better and granular risk management tools, and just pricing liquidity better compared to the risk itself. So we rechanged the whole architecture in a way where we have a concept called liquidity hubs, where all the liquidity is stored when users are supplying these assets. And then the hub allocates the liquidity into different kinds of spokes. And these spokes are just borrowing certain assets, collateral factors you can borrow against per asset. And it's a sort of credit line. So think of it as the liquidity hub is a central bank, and these spokes are more of a commercial bank with their own lending strategies. So with the Aave V4, as any kind of a developer, you can create a borrow configuration want to see, and then request a credit line from the liquidity hub and get funded. So you can innovate from ground zero without actually needing to put incentives or what some protocols do. They go and kind of like rent the liquidity. So they go and pay to third parties even like absurd amounts of funds, like 25% APY, just to get those funds into their platform, because there's a lot of computation around liquidity. So what we really wanted to achieve with Aave V4 is that every developer can actually innovate with Aave, and the more successful the innovation is, the more capital is getting allocated to that type of innovation. And this is really important because over the past 2 years, a lot of DeFi has been built, and the more I talk to DeFi developers and founders with really amazing innovation, whether they're building on top of Aave or not, they all say that one of the key kind of like issues that they have is that they are having issues to attract liquidity, and they don't necessarily want to create a token and put rewards into their product because they're so early stage of their product, and they want to see the product market fit first, or they don't have capital to rent the liquidity, which I don't think projects should do in the first place. So this will actually allow any developer to then access to the Aave's deep liquidity by creating any type of borrowing and lending in the future. So that's one of the things I'm super excited about. And the second part is this idea of risk premiums. So now when you borrow, let's say Go or USDC from Aave, every borrower pays the same borrow rate regardless of their collateral composition. So in the future, depending on your collateral composition, if it's less riskier, you pay less. You pay the base risk rate and risk premium. But if you have more riskier collateral composition, you pay more. So effectively, what we want to do is that within a single pool, we can price these positions based on how much risk they're subscribing into these pools. And this means that if you are having very lean position, like borrowing only against ETH or perhaps Bitcoin, you just pay the base rate compared to some more riskier setup. And this makes the pricing more fair because those borrowers who have that lean position, they're not basically getting overcharged. And those who then are bringing more risk into the protocol, they're not piggybacking the rates that these less riskier positions were paying. So it's a really interesting innovation on lending and borrowing.
Okay, wait, and I'm so sorry. So the I guess like I didn't understand. I thought you had initially said that they pay the same rate, but it sounds like they're paying different rates.
Yeah, so the same
Okay.
rate is the same rate is the base rate. So typically now in Aave, when the user supplies liquidity or let's say borrows, the rate is fluctuating because it's purely algorithmic supply and demand. So this concept will still exist in Aave V4, and there will be that type of a base rate. But on top of the base rate, the users will pay a premium if they are bringing more riskier assets into the protocol within accepted risk spectrum, of course.
Oh, I see. Okay, yeah. So it makes the whole thing safer for everybody. That's
Safer,
super.
yeah, safer, but also better pricing as well. And yeah, that's the kind of idea. They're priced better between what are the collaterals compositions and then ensuring that kind of like if you are not bringing risk into the protocol, you are not paying a higher rate for that. So you're incentivized basically bringing less risk into the protocol. That's the kind of concept there.
Yeah, it's more fair. So then the other thing that looks like it's on the roadmap is Horizon, which is your institutional solution for RWAs. Can you talk a little bit more about what that will look like and what your goals are with that?
Yeah, the best way to explain Horizon is that we built this really incredible technology that is applicable to native crypto assets. So Bitcoin, Ethereum collaterals, and borrowing stable coins, and it's proving to be resilient. That side of the business is growing really well. And now what we want to experiment is that we use the same architecture, but we are going to use for RWA. So with Horizon, users are able to use RWA assets, permissioned assets as a collateral to borrow stable coins with the same infrastructure. And these RWAs are assets that are liquid off-chain, but not liquid essentially in on-chain. So it really creates a new kind of opportunity where institutions that are tokenizing assets, they actually now have a really interesting use case because tokenization is just a tool. It doesn't really make a it doesn't really add value until you have some sort of kind of a use case. And for me, being able to collateralize your assets, you basically can or borrow within working outside of the working hours. You can't do that over the weekend, but you can't do that with Aave because you're not relying on people. You're relying on smart contracts that are automatized. They're resilient and trust minimized. And I think that's a kind of like a value proposition that DeFi infrastructure can do things much better than the old school type of a financial banking products. And that's the kind of like a experience that Horizon is experiment, but I think it's going to be a big revenue driver in a big kind of like a growth category for Aave in the upcoming this new decade that is starting.
Yeah, seriously. I mean, if once we look back, we're definitely going to characterize this as the time when, TradFi and Wall Street really started coming into crypto. And, obviously, we're seeing this every day, like with all the news that's coming out. Robinhood is like, obviously that was a big deal. But, even if we think about just like continued news from like BlackRock, which has already, been here for a while, or, I even saw like headlines about Western Union, and there's kind of like, it just feels like every single fintech and TradFi company suddenly has its own kind of crypto strategy, but it does look like more of them want to play in the DeFi space. So I think you guys are well positioned. So last question, I just wanted to ask, like, when you think about the future of DeFi, so here we are, Ethereum has been around for 10 years, but really DeFi kind of, you could say it's like 5 years old, because obviously DeFi summer was 5 years ago. I can't remember who tweeted this, but somebody tweeted a poll of like, what's your favorite time in crypto history? And I remember I selected DeFi summer, and then I saw it was the most popular option, because that era seemed it just seemed the most fun. But I was curious, like, when you look at where you think DeFi is headed, especially now that we're seeing this kind of connection between TradFi and crypto coming together, like, what do you think the future of that is going to look like? And last thing, because I know you guys have created your own solution here for the fact that we have like siloed liquidity at this point in time, but that is going to be a problem going forward. And I just wondered what your thoughts were on that.
DeFi summer was really fun, because you could go into a application and you put some funds and you get some things called yam or like pickle, and they have value, and you sell them, and something like you kind of like were able to create money out of it, and very memey and fun, right? But at the same time, whole kind of like DeFi summer and DeFi first wave was also, in my opinion, born out of the macroeconomical conditions. And I believe that every like a fintech or a financial, some sort of kind of like a growth happens in some sort of favorable macro conditions. So back then, COVID happened and interest rates were at zero, meaning that the only way to actually find yield or actually make money is to go to the stock market or go to some sort of alternative platforms and lending, and people were technical enough. They found DeFi and they saw like, oh, you could earn like 3 to 4% on these things called stable coins, and they're pegged to the value of dollar, and you can buy them on a centralized exchange. And then later in the summer, you had these governance tokens that actually you were getting ownership of these protocols, and then you have additional revenue, so additional APY. So it really gave a big contrast. And then these funny yield farms actually then made it even crazier, because you saw double digit or like 3-digit numbers for a while. So the macro conditions were there, And I think that the next big catalyst for DeFi is going to also be macro. So interest rates are going to go down. So it's happening already in Europe. They're at 2%. And Aave is actually now, if you borrow USDC, if you supply USDC, Euro C onto Aave, somewhere average of 4%, which is double of the
Yeah,
European
4.9, I
Central
think.
Bank. Yeah, it's basically beating every single fintech in Europe. And then the central bank in the UK is going to drop their rates and already starting. And Fed is keeping it's still on hold to drop, because if it's for a long period of time, the economy will start slowing down, because people and businesses, they don't have enormous appetite to operate and borrow interest in environment. So when that starts to happen, you will see again this spike that DeFi opportunity increases compared to the traditional finance, and it's going to be really a big catalyst again for DeFi. And stablecoins, why they're so, it's the only way to access DeFi yield. So if DeFi is going to be the place where the best financial opportunities will exist, because it's an environment where there's the best programmable algorithms and even AI on top of that, that actually searches for this revenue, you need stablecoins. And then you need RWAs to grow, because native crypto assets can go so far. And if you need yield for 8 billion people, you need an ecosystem. Stablecoins already, the centralized ones are already essentially doing that. So RWAs, DeFi, stablecoins are just kind of like a triangle that will be like the key components for DeFi growth. And then good macro will make DeFi more attractive. And then we'll see like more fintechs integrating Aave and more banks integrating Aave and DeFi in general. And that's going to be the main thing. And liquidity segment, I think, has been always a little bit challenged. And I think that's what we are trying to solve with Aave V4, where all the liquidity can be stored in these liquidity hubs and then just allocated to different types of lending and borrowing strategies. The more concentration there is on liquidity, the less friction there is and better product. So my hope is that we get away from this kind of like fully KYC models. I understand that for some financial institutions, a fully like a KYC version of Aave is essential at that point. But I really hope that we move towards direction where institutions are comfortable with permissionless liquidity down the line. Institutions abandon the whole private blockchain type of idea that existed 2 years ago that didn't really make any sense, because blockchain as a network, it makes sense, and DeFi as a network makes sense when you can connect peers together across globally and increase this liquidity opportunities down the line. So that's my kind of like thinking and also hope.
Yeah, actually, I do want to ask one more question, which is just we are seeing that in crypto and DeFi, there's like a swing toward centralization, I'll just call it. So the ApeCoin DAO is, they're going to go more centralized. Miles Jennings of A16Z said that he thought the foundation model was broken. And, there's just been talk generally, you see more people talking about how when you have a token team, but this, other entity, this foundation is kind of more in charge of the token, there's like this disconnect between what the real incentives are and like who can kind of deliver on that for the users. Another example is the Jupiter DAO kind of pausing on DAO voting for 6 months. And I just wondered what you thought about that. Like, I wondered what you thought about how the DAO experiment has gone so far for DeFi. Like even another kind of data point is, Pump Fund had this massive ICO, but they're a centralized company. It's not like they're saying you can have this token and it gives you governance rights, or, no, that's not what they're offering. So just curious for your thoughts on that kind of trend.
Yeah, I think the model is hard, where essentially you have a foundation and you have a labs, and they're essentially somewhat doing the same thing. There's no clear value proposition. I think kind of like Uniswap somewhat is suffering for different reasons, but I think that Uniswap model is difficult because the the foundation doesn't charge the fees, and then the labs gets all the fees. So it creates like a really imbalanced equilibrium between the DAO and the labs entity. Where I think what's interesting in Aave DAO is that the protocol is earning revenue, and it's really actually hard to make a really revenue-driven, profitable DAO. Like it's so hard to actually accomplish that as a business where everyone is aligned and there's a clear structure and hierarchy. Whereas in a DAO, you have a lot of coordination and so forth. So I'm really proud of like where the Aave DAO has been able to, and so far to achieve, and a couple of other examples in DeFi, because it's extremely hard, to be honest. But you achieve a lot of resiliency that way. And I think that the way to manage this kind of imbalance is that not have it by having like a clear mission. So obviously on the DAO perspective, that's to actually govern an infrastructure, set economical fees, which is, in my opinion, the most important aspect of it. Like there's a lot of parts that can be actually immutable, reduce the governance overhead, but managing that economical piece is the most important. And then on the last perspective is simply of increasing the distribution. So if the labs fully focuses on distribution, and then the actual DAO focuses on the economics of the protocol, then you have like a clear separate missions, but that are actually feeding each other. And whatever distribution the labs can create, then that goes into the protocol itself. And then obviously protocol development is another thing, but that's also can be done in a very decentralized way where there's multiple teams and contributors. And obviously Ethereum Foundation, Ethereum ecosystem is a great example of that. So I think it's a more of like how to align incentives, and in most cases where they don't work, these incentives aren't aligned, as an example. So does Uniswap Labs, for example, hold enough Uni tokens? If not, maybe that's one of the reasons why they might be less interested, and vice versa. I don't know the actual answer to that exact question on their part, but that what I would assume where the kind of like frictions come if there is not enough alignment between these foundations or labs entities and the actual DAO.
All right, Stani. Well, this has been a super fun conversation. Thank you so much for joining me on Ethereum's 10th anniversary.
Thank you so much for having. It was really very much fun.
All right. Thanks, everyone, for joining us today. To learn more about Ethereum's 10th anniversary and Stani and Aave, check out the show notes for this episode. Unchained is produced by me, Laura Shin, with help from Matt Pilchard, Juan Uranovich, Pam Majumdar, and Mark Akuria. Thanks for listening.